Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe with Streamline Capital. Really excited for today's show. We've got the one and the only Ross McArthur on the show today. So Ross, welcome to the show.
Thank you very much. As a longtime listener, I'm finally glad that we actually be able to connect face to face. So official introduction, and I can tell everybody now I know Brian Briscoe.
Woo, woo. Yeah, we've been connected on LinkedIn for a while, and I guess in the last couple of weeks, I've really seen your LinkedIn game. Well, probably LinkedIn algorithms, but I've been seeing you a whole lot on LinkedIn recently. So got a lot of good content coming out there, and yeah, I'm excited to talk with you. So let's start by telling your story. Tell us, about where you came from, and basically lead us up to where you got into real estate.
Yeah, so I always say I'm a Midwest kid, born and raised in Michigan, went to school in Michigan. And then, like most people, when they graduate, didn't know what I wanted to be when I grew up. And so I chased corporate America, moved around for almost 15 years. Most of my job was in sales executive type of roles, moved my way up ultimately to a vice president role, but lived all over. And really, the last going on 11 years, we've been down here in Florida. And so we were just laughing about school letting out, kids jumping in the pool, trying to tell them to be quiet while we do a podcast. But it's been a fun corporate journey, but always on the side, and really since I was about 16 years old, had a calling for real estate. Nobody really around me did it. I just found it intriguing and interesting. And then in January 2020, we finally jumped in and bought our very first fourplex, and that was in Indiana.
Awesome. So let's dive in right there. I mean, 2020. What was going through your guys' mind before buying that fourplex? I mean, you were in a comfortable job, assumed things were going pretty well, but what drove you to buying that fourplex?
Well, really, so anybody who knows the automotive sector realizes, 2007, 8, 9, that time with the crash and things, auto was very much hit and affected.
Yep.
I grew up in Michigan. Most of my family was employed or somehow had their, connected to the automotive space. My now wife, her dad had his retirement cut almost by 66% overnight.
Ouch.
And I remember him walking in and looking at me and just having that pale face saying, there goes retirement next year. I'm going to have to work 10 more years to get that back. Luckily, it wasn't. There were some buyouts and there was some other stuff that happened. But that moment when I realized I wanted to take control of our retirement. And so the first fourplex, I mean, honestly, very simple goal: lower my retirement age. That was it. Wasn't to quit my job, wasn't anything else. And so we bought that first fourplex, and I joke like it went pretty well. We could buy Chipotle once a month off of it. Like, we're really not. We're not killing it, but we're not losing money, and it's kind of paying for itself. And so our sole focus was, again, just the lower retirement age.
Yeah. And I like that you say that, because a lot of people think that, you buy one or two or three properties and it's going to, make or make you, but I remember the same thing, buying the first house and the second house and the third single family property. And, most months, you're right. I could eat a couple of lunches at Chipotle, but for me, the power was the time. And my first one was 2007, right before the market crashed. So I timed it perfectly. And for those listening, I'm shaking my head, left to right now. But so you bought the fourplex to reduce the retirement age. How did it go from there? I mean, what besides, once a month Chipotle, what about that first property kept you going?
Well, I will say you asked about that first property. I'll make one point. I was terrified. Didn't know well. I mean, I was 75% there education wise by listening to podcasts like yourself and other podcasts out there just on real estate. So I knew enough to be dangerous, but I was still terrified. And so you look back on that now and it's kind of funny, right? But so that went pretty well. And at that point, I looked at my wife and said, okay, let's double down. And so we started buying off market deals, doing some direct to seller stuff. And we quickly scaled in about 18 months to 125 rental units, all in this general market. And we also started a flipping business at the time. And so I'm still working at the W-2 at this point. But we're really trying to create velocity and money, which a lot of us talk about. So most of the money that I made on the flipping side just went back into buying more apartments. And so that took us right up until about 2022. And that's when my partner, Stan Remling, and I got together, having similar conversations often about retirement. It's just too slow. And, we kind of figured out that a 2 and a 4 unit property was similar work ethic as it would probably to be something larger. So we decided to create an investing company between us for 20 to roughly 120 unit apartment complexes.
Mhm.
So I'm going to pause real quick there because I
Yeah.
don't want to jump around too much on you.
So let's back up and you talk about the partner. How did you partner up with this individual? And I'm sorry, I've already forgot his name already. You say
It's
Stan?
Stan Remling. Yep. Yes, sir.
Stan. Okay, good. So how did you and Stan decide to partner up?
Well, one, it helps when you really know somebody. So he actually
Mhm.
lived 2 blocks down from me.
Okay.
So he works high up in Disney here in Orlando, and he works on the data side. And so he was already doing properties, small scale, 2, 4 unit properties himself. So he owned about 20 units at the time. It was just finding somebody who was like-minded, who had slightly different skill sets than I did to work together.
Okay.
So it kind of happened since, but we did a lot of that dating phase, as a lot of people talk about, before we actually decided to form an individual company.
Okay, awesome. Now, how many of these deals, I mean, you talk about the flipping company and you talked about, taking those funds and pouring them into these multifamily projects. Was he your partner through all of that, or when did he come into the mix, I guess is what I'm asking.
The original OG partner, Katie
Mhm.
McArthur, my wife.
Okay.
Nope, that was just her. That it was just me and her family business, and
Mhm.
those businesses still exist.
Okay.
So those are still operating. We just put 2 properties on the market for sale on the flip side this week. So
Mhm.
that's still that, and then we have Follow the Deal Investments is really the larger syndication
Mhm.
of investing company.
Okay, awesome. So the flipping is you and your wife, the multifamily is you and Stan. All right, got it. So I think we're in a good spot. So let's look at that transition into getting into multifamily a little bit deeper. What was the allure to you to getting into multifamily? Going from a flipping business, which appears to be successful and that the 125, 150 or so units you guys have purchased, what was that next carrot you're chasing?
Yeah, so I'm a people process technology person just because I was in software for so many years. So
Mhm.
the flipping business, even though I have that pretty dialed in process wise, obviously I'm in Florida, I flip houses in Indiana. You better
Mhm.
be pretty good at processes.
Yeah.
Most houses we've never stepped into. However, it's still an active business and you're only as good as your next flip. We really wanted to build our velocity of money. So we were taking that and then putting into value add apartment deals.
Mhm.
And that ultimately would allow us to really ramp up for our retirement that we were talking about and lowering that
Yeah.
retirement age because we're actually producing cash flow. We're adding value to these properties and can hold on to them long term.
Awesome, awesome. All right, so how about this one? What were the biggest challenges moving from what you were doing into multifamily?
Well, one of them was I didn't talk about real estate openly outside of like close friends and family. Because remember, I was in a big W-2 job. I was a vice president of sales for a company. So I didn't want it to look like I wasn't dedicated to my job because I was. I just was spending every other waking moment on real estate, which is part of the reason why my wife eventually told me to move on. But at the time, the biggest thing was educating people on what we did. And what I found the struggle was the more you talk to people about it, it was more of a turnoff. You have to
Mhm.
talk about it, and it's like almost like a bug zapper,
Mhm.
that light out there, and the bugs kind
Yeah.
of zap into it. When you just kind of talk about it, things like LinkedIn, your podcast that you do, people are intrigued and then they eventually come to you, but that takes time.
Yeah.
And so we had a big, big rush of funds from a lot of friends and family that were working big corporate jobs when it came to capital raising and
Mhm.
funding. But the next hurdle was really getting that next layer of people
Yeah.
that needed time and kind of come to that decision on their own.
Yeah.
And that took, 12, 18, 24 months. And
Mhm.
so that was a big hurdle. And to be honest with you, the other big hurdle was property management. And that led to us eventually starting our own property management company. When you're, mid-size or even larger for the region or the market,
Yeah.
nobody's going to handle your properties like you handle. And there were some big deficiencies in property management. So, to kind of round out that answer, capital raising and funding, of course, is
Mhm.
always, I think, a biggest challenge in our world. And then, asset management slash property management was definitely 1A, 1B.
Something I saw on LinkedIn today. A lot of people say that there's this quote that you make your money when you purchase multifamily or when you purchase real estate, which is not always true. What a lot of people don't realize is how hard it is to actually operate the properties. And so you're talking about the two quintessential problems that everybody has. It doesn't matter how much money you start out with, you're going to eventually run out of money and you're going to eventually tap out the money that your immediate family and close friends have. So a lot of people have that exact same challenge of, okay, everybody close to me has already invested. What now? How do I get to that next ring of investors? Number one. And number two, the oh crap moment. I think the two biggest come to Jesus moments I had in multifamily was the day we got our first property under contract. It was high fives around and then like, oh my gosh, what did I just do?
Now
You
the
know,
work begins.
well, that was getting the property under contract. And the
Oh,
second one,
not even
yeah.
closing on it
The
yet.
second one was the exact same thing when we closed. It's like, all right, we closed, high fives around and like, oh my gosh, what did we just do? We now own 55 unit apartment complex. What are we gonna do? But yeah, I think you at least hit something that resonates with me because those were the exact issues I faced up front. So capital raising, how's that been so far? What have you guys done and what are you looking to do to, hit that next level with the capital raising?
Yeah, so I think very fortunately, I didn't start when I was 22. I didn't start when I was 25. Essentially, we started the group investing business when I was 37 years old with 15 years of corporate America experience, right? So that means all my friends and family around me had 15 or 20 or 25 years of experience also, which also means they're in a different tax bracket now than we were when we were young. And
Yeah.
so the close-knit group, that was, I don't want to say easy, but we
Mhm.
funded our first three projects, and it was probably $2 million
Mhm.
without really breaking a sweat. And thank goodness, though, our friends and family trusted
Yeah.
us on that. And we really did pretty good along. But what is one of the number one questions that people ask you? And now you have a track record. Hey, give me a case study. Tell me
Oh
how
yeah.
some of these projects did. And I'm like, well, I've done 100 transactions. They just on small multifamily and single family flips. Like, well, that's not, what about this
It's
business?
not the same. And that's what
Yeah,
people say. Oh, I mean,
yeah, not the same.
it is not the same, but it's also, yeah, we get that all the time. I mean,
Yeah.
I just closed up shop on a partnership in that was centered in South Carolina, and now I'm in Salt Lake. And it's like, well, Salt Lake's not the same. And it's true,
Yeah.
but it is a real hurdle that investors have to get over. And so yeah, how did you tackle that?
Yeah. So one, I leaned into just the sheer volume of transactions because at the end of the day, if you're buying and selling real
Mhm.
estate, you have a certain knowledge level and experience level. You're just doing it on a larger scale.
Mhm.
And so I did lean into that. But then the second part is like, how do you create a track record unless you get started? Like, it's just like being a new hire. They're like, well, you don't have the experience. Well, how do you get the experience? You got
Yeah.
to start somewhere. I went through that, and most people understand that. And then it's, them really vetting you and going through that process, even your W-2 background, where you were, what you did, what type of track record you have. But then the next phase is we have to get that case study. And so we've moved to dispositioning three properties on the smaller scale, a 26 unit, an 18 unit, eventually our big one that's 129. Well, two are listed and under contract right now, and one will get dispositioned at the end of the year. To your point, really the
Yeah.
main goal is to give a great return to then show when Brian asked me, hey, give me a case study. I'm like, boom, here you go.
Here it is. Here it is. Interestingly, I had this discussion with my investor relations guy this morning, actually. Like I said, I've done one deal in Salt Lake City. We've got a couple under contract, and he's trying to get his friends, family, and people to invest. And he's basically relaying these questions to me. And we basically sat down and tried to figure out what's the best way to message things.
Mhm.
I have a track record in South Carolina. Okay. I've got 9 exits. We
Yep.
did very well on those properties. Okay. One property, we hit 42% annualized returns.
Yeah, it's huge.
Ridiculous numbers, right? On average, we were about 20%. So on average, we did well, but it wasn't like spectacular. But, how do we answer the questions? Sure. What about Salt Lake? Should I tell you what we came up with?
Yeah, absolutely. I think everyone would like to hear that. I want to hear
Yeah.
it.
Well, what we're starting to do is we're starting to show what we're doing on our other Salt Lake properties.
Yep.
It's just like, and that was my LinkedIn post today. And for people listening, today is May 29th, 2024. So go back into LinkedIn and find the post. Actually, I'll have my podcast editor throw it in the show notes. Okay. But one of the things we're doing is we are broadcasting our results. It's not a full cycle exit, but we made a distribution today. All right. And so we're shouting that, out to the world. We made a distribution today. Okay. Here's where we are on our progress. And so what we've decided to do is broadcast the little successes, broadcast our progress with the other properties. It's not as cool as showing, hey, we've had 9 full cycle deals in Salt Lake City, but it's the next best thing. That's really, I think, what we can do where we're at right now. And I'd say for those listening, the learning point there is figure out what you can do. You might not have the optimal solution, but figure out what you can do and do it. Boom.
We
Yeah.
shared a BOV that we got on property that we're not selling, but from one of our top brokers for kind of the same reasons to kind
Yeah.
of show and then we showed income when we bought it to income where it was at and NOI. But you're right. I mean, that's a great point. And I
Yeah.
bet you're going to get a lot of positive feedback. And I saw it on LinkedIn myself today. And the transparency is good. And you were also transparent about what it took to get that distribution out, which I think
Yeah.
is just as important.
We had a couple of very difficult and busy months, and that's what a lot of people don't see. A lot of people invest and we've had some investors like on this particular deal, at the 3-month mark, we were sitting at 80% occupancy, which was not a spot any sponsor ever wants to be in. And I remember taking a question from one investor. I said, look, this is a 10-year hold. All right. If this
Mhm.
were a football game, we're on play number 2 right now. Okay. First
Mhm.
quarter, we've had 35 seconds go by on the clock. This is where we're at right now. Okay. We didn't fumble the ball. Okay. We had 2 plays and we didn't gain any yards. That's where we're at. It's 3rd down. So being transparent, it exposes yourself to a lot of questions that are sometimes difficult, but at the same time, I want these guys to invest in other deals, and if they see that we're working hard, they see that we're transparent, a lot of these guys appreciate it and they're going to come back on the next deal and the deal after that and the deal after that. So anyway, yeah, yeah. So back to you. Sorry, I'm trying
No,
to stay.
honestly, that was a great conversation. We could have talked
Yeah.
about that for 15 more minutes.
Back to where we're at with you. So you're in the syndication. We talked about the capital raising a little bit. Operations side, you mentioned property management and having difficulties, with the management aspects. Let's dive into that a little bit deeper. So let's talk
Sure.
about kind of some of the struggles you guys have had and what you guys have done to try to overcome those.
So we ramped up pretty quickly. So our first property closed in September 2022, and pretty much a property every month from that point on, up really until the beginning of this year. Slowed down, did a couple properties the last month. Property management, we were using third party really up until about a year ago.
Yep.
And that was strategic because we weren't at the size or capability, or to be honest with you, at the time, I didn't really want to
Yeah.
take property management in-house. But what I started to find out, and when you really start owning an asset and digging into AppFolio and backend systems and seeing how people are talking to tenants and the follow-up that's happened, you won't sleep at night.
Mhm.
And that's what we started to see. We started seeing wasted dollars. We started
Mhm.
seeing just inefficiencies in every area. So we made a decision when we hit 600 rental units as a group, myself and Follow the Deal, we
Yep.
were going to officially kick off the property management company.
Mhm.
And so we created a hub and spoke model. So
Mhm.
essentially, we have a hub in Indiana where there's a couple employees out of, and then there's regional property managers who cover regional markets, and then a CFO who is out of state, who's a good friend of ours, who does
Yeah.
all the bookkeeping and accounting. What we saw is what everybody else, in our opinions, those inefficiencies were, and leaned into that and then against it. So
Yeah.
we really tried to structure everything from top to bottom to be the most effective with the least amount of people as possible.
Mhm.
And there's always struggles when you start a new company,
Mhm.
but the one thing I'll say is we operate 2 to 3 times better than anybody else did for our properties, I should say. And so there's struggles just with new hires and people and things like that. But as far as just property management 101, operating the properties, there hasn't really been a struggle because part of the reason is each person we brought on had 10, 12, 18 years of experience.
Yeah.
And so fortunately, they could really help us on the operations side. We just helped them with processes.
Yeah, I think everybody who starts accumulating units is eventually going to have to make that decision. You can be a lot more efficient if you own the company. You cut the overhead out. I was asset management call this morning. We had 3 people from the third party management on a Zoom call this morning. All right. Guess how many of them contributed to the meeting? One was the answer. Every once in a while, the regional will pop in and say something. I mean, first of all, they're doing a great job managing the property, right?
Yeah.
But when you start looking at the overhead, we pay their payroll, and so that hour, I'm getting billed 3 times for that hour, right? So
100%.
when you start looking at the efficiency, I think you mentioned, nobody else is going to manage your properties like you're going to manage them. Okay. So number one. And number two, the other inefficiency that I dislike with property managers is, they hire and they make assignments,
Yeah.
and I've complained to property managers before saying, I don't like this person. And I've had them tell me that's tough. That's who we're putting in here. And it's like, all right, we've actually left property management companies over that. So they do a really good job, hopefully, managing your property, but it's never super efficient.
What we realized is me and you are owners. We were in the same industry, but we might have different standard operating procedures. And so a lot of times these property management companies have 50, 100, 200, 300, however many ownership groups who
Mhm.
all have different standard operating procedures. And
Mhm.
so they're creating internal processes to try to appease every owner. And that was another big inefficiency we saw. So
Yeah.
when you bring it in house, you have one standard or operating procedure. It's yours.
Yeah, exactly. And I mean, there are some property management companies that will adjust their procedures for individual owners, and there's others that won't, and
Mhm.
that's what I found as well. Some of them are like, this is how we do it, take it or leave it.
Yeah.
And I think it makes sense from a certain point of view. If they're managing, thousands of units with, a couple of dozen different owners, they don't want to have a different playbook for every owner. So it does make it where it can be inefficient. And the leasing agent that's on the conversation this morning that was doing, 95% of the talking on our call, he is also the leasing agent on one other property that's about a block away from ours. And so anyway, the nice thing is, with these third party property managers, you can sometimes gain some efficiencies that you couldn't on your own. But man, if you got 600 units, you might as well bring it in house. I like it. Now, here's a question. Why 600? I think 600 was the number you said. Why 600?
Yeah. So actually, we backed into it and realized that that would be in the black as a company and essentially make like 50, 60, 70 grand, somewhere in that range originally was our projections
Mhm.
off day one. And we did not want to start something to operate in the red. So simple equation, figure out what the average rents are across the portfolio, multiply it by a management fee, and boom, that number of units got us into the black with some profit to remain.
Okay, nice. That's a really good way to do it. And something I always think about on this one is, if you're planning on growing, do you pull the trigger before it's profitable or not? And I like how you guys did it, just a very detailed, very calculated, very much, okay, at 600 units, it's in the black for us. And oh, by the way, we're at 120 in Salt Lake right now, so we're still a little bit away from pulling this trigger. But my point of view, tell me what you think about it is, we'll probably pull the trigger a little bit before it's profitable, just so that we can have things set up, ramped up, and be ready for future growth.
No, actually, you're dead on. I didn't tell the story that we technically kicked it off at 500.
Mhm.
But by the time you
Oh yeah.
actually launch and that lead time and all that, we made the decision almost 3 months before and hired people and got ramped up in the background, figured out what software, all that stuff months before we were at 600. We were only about 500 at the time. But we knew when we hit 600, whether it's when we're operational or 3 months after, we would be in the black, and we knew that number would come. So
Mhm.
I think your opinion is spot on. You want to start up
Awesome.
early. Yeah.
Awesome. Awesome. Well, I mean, it's I thought I was throwing out a contrarian, point of view on this one, and turns out that we're in lockstep on that one. So
Okay.
I haven't come up with my line in the sand yet as far as property management companies. My line on the sand with I think my next hire is going to be an asset manager,
Hmm.
and my line in the sand on asset manager is probably 4 properties. Once
Yeah.
that fourth property is through. And it's the same mindset. I'm looking at the asset management fee that we're getting on these properties, and it doesn't quite pay for a full-time person, but I want that full-time person to have procedures established, be, really, really hyper focused on making sure their procedures are just spot on, before they get thrown into the fire where I actually need them, full time. So
So turn it back on you. Why asset manager next?
because that's something that I'm not super great at.
There you
Okay.
go.
I can do it, and
Yep.
for 20 years, I was active duty military for 20 years. The best way I could explain my role is I was essentially an asset manager for most of that time. All
Mhm.
right. I can do it. It is not where I thrive, but I can do
Great
it.
point.
And so when I say, one property, two properties, three properties, I can manage three properties. When we get to four properties, now I think my time is probably better spent somewhere else. And it's probably better for me to start paying somebody else to do it slightly better, and
Great points.
hopefully somebody who thrives in that environment. I can do it, but it kind of becomes a chore for me. And it's like, asset management call again, crap. But
At least
uh,
you're leaning
yeah,
into it.
yeah, so definitely leaning into it, and we're already looking for people who are a good fit. Assuming things go our way, it'll be before the end of this year that we pull the trigger on that one. So let's take a slight peek into the future. I'm looking at the time right now.
Yep.
Your kids are gonna start yelling and screaming because you told them 45 minutes, and my kids are gonna get home from school right now. But let's start leaning into the future a little bit. What's next for you?
Yeah, so I always say I never thought we would be here in this amount of time or really here in general. So it's
Mhm.
always hard to predict even the next 12 months. So I always say like a lot of the same,
Yeah. Yeah.
like, kind of rinse and repeat. What's working is working. But I do, like I mentioned, we want to disposition a couple properties. We obviously want to get to a level where it's creating enough income from our side to really make a significant difference. That's probably a few hundred more units over the next 12 to 18 months. We did a big water park deal and family fun center campground in Old Forge, New York last year. So we're going to do a second property like that this year. And
Nice.
then I think it's just continuously getting better operationally. So I know that probably isn't like significant milestones, but that's truly where we're at.
As long as you're being honest, I think that's all that matters. If you were to come in here and saying that you're, going to start a, film production company, but yeah, I'm teasing. But, if you asked me the same question, the answer is really going to be more of the same thing. That's what we're doing. We're going to do more of the same thing. Guess where my next acquisition is going to be? Salt Lake
Salt
City.
Lake City.
Guess where the acquisition after that's going to be? Salt Lake City, and it's
Yeah.
gonna be more of the same thing and just, adding on, getting better at what we're doing. And I think that's a great answer. What I worry about, and this is something I've seen, I did a coaching program like 6 years ago. And out of the people that I still keep in touch with from that coaching program, very few of them are still doing multifamily right now.
Hmm.
You know, some of them have moved to industrial, some of them are doing, like, one guy just raises money for oil and gas. But when you look at it, from an investor standpoint, what do I want to hear you say if I'm wanting to invest with you? I want to
You're
hear
doing multifamily. I better say multifamily
you better be
in
saying
Salt
more
Lake
of the same
City.
thing. Yeah, more of the
Yeah.
same thing.
Yeah.
And I want to keep on getting better and better and better at what I do. That's, in my opinion, that's the right answer. Okay. Everybody has their own right answer though. So
Yeah.
had you said something else, I would have just, given you the stink eye and moved on. I said, well, congratulations. Good luck. No, I'm teasing. But all right, one or two more questions, and I think we're gonna wrap this up. So, what advice would you give to somebody who's just starting out on their multifamily investing career?
Well, I think one is avoid shiny objects. The shiny object syndrome, as I call it, in the car dealership and automotive world, that was very real. In the investing world, that is very, very real. You see people on LinkedIn, on social media, they have an idea what investing is. And then they'll go and they'll see somebody do industrial, they'll see somebody do short-term rentals, they'll see whatever the next thing is. And they start to just do this. It's a big wavy road. And to what you just say earlier, it's like get into something, get very good at it, and then continue to grow and scale it. So I think one is define your goals. Whatever that goal is, define it, and then figure out an investment strategy that aligns to that goal.
Yeah.
And at that point in time, when those two, that's A and B, are figured out, then what C is you do not pivot away from that for a while. And
Yeah.
you just go your head down and you just do you. And what will ultimately happen is when other things come up and they don't align to that goal, you just don't do them. You just
Mhm.
ignore it. or you just say no, right? No, I'm not. I'm doing this.
Yep.
And that doesn't mean you can't ever switch. I'm just saying, early on, that's your number one focus. The small second thing I'll say, it's one of my favorite sayings, and it really doesn't make a lot of sense, but it does, is, how do you eat an elephant? It's one bite at a time. I mean, when you start out investing, you start
Yeah.
hearing conversations like we're having, like none of us thought we were going to be here. It was all about buying property one or property two or property three. So, whatever you want to accomplish, you just got to figure out how to get started and then put one foot in front of another. And bit by bit, next thing you know, you've built something.
Yeah. Yeah. One of my favorite quotes, and I used to ask people what their big burning why was on this podcast. That term was me misquoting Stephen Covey, on accident. I accidentally misquoted Stephen Covey and it stuck. But, he has a similar theme in his book, 7 Habits for Highly Effective People, about saying no to things. One of the things you're supposed to do is to focus, is to be able to say no to a lot of things. And he said the best way to say no is to have a big burning yes. And if you have a big burning yes, it's really, really easy to say no to everything else. It's really, really easy to say no. And I think you can see this in lots of examples. Athletics. The guys who do really well. They're the ones that are focused on the outcome. And when their buddies are out partying in high school or college or whatever, they're in the weight room, they're getting sleep, they're doing things right. But yeah, you have to have that big burning yes. And that way you can say no. I love how you put that. That really, once again, resonated with me. So anyway, last question as we wrap this up. How can listeners learn more about you?
Well, you already mentioned it. I've really tried over the last year to put out some real transparent content. I'm a big financial literacy person. I'm a big mindset person. So you'll find a lot of information. If you're just into that, follow me there. That's where I put a lot of my time, energy, and effort. And of course, about investing. So again, Ross, ROSS, McArthur, MCARTHUR. And then, of course, our website, followthedeal.com.
Awesome. Followthedeal.com. And anyway, Ross, thanks for coming on the show today. Very much appreciate your time today, and look forward to seeing you a little bit more on the LinkedIn or whatever we want to call it. So, all right, thanks. Appreciate it.